Hello, ladies, and welcome to your first meeting. Oh my goodness, it's so great to see all of you, especially for money. Get the yucky stuff out of the way right at the beginning, right? Finances. I'm sure you were all crossing your fingers that you're going to be doing marketing and branding and all that fun stuff. But you know, obviously, I'm a money expert, and so I believe money's number one in business. I'm going to talk to you a little bit about that today. But my objective today with all of you as well is that hopefully, fingers crossed, you'll come to appreciate it just a little bit more. I'm not going to ask you to fall in love with it today, but I want you to start realizing that your relationship with it and how you feel about it is all just a matter of this. That's all it is. So we're going to go on an interesting journey today, to be certain. But before we do, I actually just want to give a shout out to all of you, obviously the team at West, for putting this together and for entrusting me with these lovely ladies this morning on the topic of finance. None of you are going to drop out after this, that is for sure. But for all of you, where you're at in business, now it's my understanding that many of you are sitting anywhere in this range of 100 to 250,000 in annual revenue. I hope I have that right. You have accomplished an extraordinary feat. And I want you to just step back and really celebrate that. I know as entrepreneurs, sometimes we're just always looking at that next bar and that next level. And it's like, really take a moment to take that in. Because you know what, in 2006, our government actually reported on sole proprietorships as well, not just incorporated companies with registered employees. And when they reported on sole proprietorships and incorporations, fewer than 98% of businesses actually made it to year 2. So where you are at right now, you are already the cream of the crop. And oftentimes we don't celebrate it. So I wanted to put that out there. You've obviously hustled, you're committed. And you know, the thing that is so brilliant about where you're at and why I love speaking with you today about this is that you've established what's called proof of concept. Your business, if you're trending at that revenue, your concept has already been established. Unlike a lot of startups or people that sit in around that $50,000, $75,000 mark, unless you're selling $125,000 vehicles and you've only sold 2, you've established proof of concept. So again, I'm just bringing that out there so that you can celebrate that, because that's important. It's important to celebrate our wins. The other reason why I'm really excited to catch you today is because the bankruptcy that you heard about, it wasn't because I wasn't making money. My business was actually generating, and this was back in 2008, 2009, my business was generating close to 4 million in annual revenue. What happened for me though, is that when I was at the stage that you're at now, I grew and I scaled. And what happens when you start scaling at this stage, yes, your team grows, your revenues grow, but your flaws also grow. The mistakes that we have right now in our financial model are going to get bigger. Everyone keeps thinking you make more money and the mistakes go away. That's what happened to me. My mistakes got bigger. My net profit, the deficit got bigger. And I just ended up in this hole that I couldn't get out of. And then 2008 hit and it exposed everything, which is what COVID has done. COVID didn't cause the financial fragility, it simply exposed it. But I want you all to know that there's a fix. And what we're going to talk about today is primarily the mistakes a lot of business owners make and what the fix is. And I'm going to be throwing a lot of numbers at you. I'm going to be throwing 9 little mini processes out at you. And I don't want you to get bogged down in trying to remember exactly how you're supposed to do this, because that's going to be impossible. So I want you to know that I have all the tools for you. I have all the templates for you. I am here to show up for you as you go through this process. What I really want you to take away from this today is that there is a process. So unlike marketing or human relations, where we've got all these variables and emotions to deal with, and we're trying to figure out what's going to work and what isn't going to work, finances arguably are the easiest part of business. because it's black and it's white and it's objective and numbers don't lie. It's the easiest part of it, but it's our relationship with money, which is why we push the darn stuff away. So this is all the great stuff that we're going to talk about, but that's where I wanted to start off and open us up. Any questions so far? Candice, if it's okay with you, I'm not great at multitasking in terms of watching the chat and doing the presentation. And so what I would love for you is if there's questions as we go along, if you can just fire those out, don't even wait for a window, just go, hey, we have a question. And for all of you lovely ladies, when you have a question, please ask it. Ask it in the middle of us going through this content, waiting till the very end, because it's going to be top of mind for you. And I promise you, if you're asking it, if you're thinking it, somebody else is too. So no such thing as a silly question in all of this. All right, I am going to share my screen because numbers are best presented when we can actually see what we're talking about here. So sorry, let me just move my dashboard and I'm going to go through a couple of slides with you quite quickly here. The only thing I want you to take away from this slide, Candice did a lovely introduction. Thank you again, Candice, for that. What people will sometimes affectionately call me as is the financial fixer and the money mentalist. So the work that I primarily do with big banks, including BDC, for entrepreneurs across the country, is that I come in to fix their financial model. These are typically businesses that are in the millions, that are making a lot of revenue, but they're not generating net profit and they don't know where to find the flaw. So that's one of the big pieces of work that I do. And then the money mentalist is really the last 5 years of immersing myself in the study of what's called behavioral finance and neuroeconomics. Because I can tell you, I can give you all the tools out the wazoo, tools and templates, and you'll be like, and you'll be really excited at the end of this presentation to go, go, go. That's your prefrontal cortex. And then over time, our subconscious starts to come in and we make all these excuses for not doing the work. So the money mentalist in me is the one that understands why we aren't doing what we know we need to do and why we do what we know is not really in our best interest. So that is my work. The key intentions, as I talked about, one thing I want you to realize today in the level of business that you're in, I'm going to spend a little bit more time on a tool that I call the highways and hazards. And this is actually the first of the processes that I want each of you to do. It isn't in the top 1 to 8. This is why I'm talking about it ahead of time. I'm going to show you step by step, but basically it's about taking all of your financial data that you have to date and actually seeing what is working for you and what isn't. And then we can start looking at how we fix the problem. Again, I want you just to have a very high level perspective on how numbers come together, to understand what the common mistakes are, and please don't make them, and obviously what best practices are, and start to train yourself in that area. And most importantly, I want you to see that there's a very simple process to all of this. It's a simple process. It works every single time, regardless of what stage of business you're at, what geography you're in, what industry, it always works. And most importantly, from our time today, I want you to start retraining your brain to understand that it is all about profit, 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 profit. And to be very clear, it's about net profit, not gross profit. The difference between the two, income minus your cost of goods, and we're going to go through this in detail, equals gross profit. And a lot of people talk gross profit because the number typically looks pretty good, right? It's either top line sales or it's gross profit, and everyone gets to hide behind gross profit. But you take gross profit and you subtract operating expenses, and now you're left with the real number, which is the net profit. That is the indicator as to how you're doing in business. And I'm going to get into why that's important and some of the things that I see with net profit, but I wanted to make sure that we're all on the same page with respect to intentions. So today, where I'm going to be focusing my effort is actually on the business side of money management. But as Candice was pointing out in 2009, I've shared a little bit of this, I had to declare my business bankrupt. And my husband, at the time, he was an entrepreneur. He had a Ducati dealership, was generating $14 million. He had, a huge team. There was lots of, especially in Alberta, there was lots of ego around a Ducati dealership, and we were wearing the leather jackets and living the life. But again, in 2008, his financial model took a hit. He was carrying too much debt. So all of this to say that when I declared bankruptcy, I want to just step back for a bit, because my whole life I had struggled with money. $21,000 of debt when I was 18 on a Holt Renfrew credit card. I continued to accept low-paying jobs, thinking that I'll get into the job, I'll prove my worth, and then my compensation will follow suit. And even in business, I had a really hard time charging the right price. And all of that stemmed from this low sense of self-worth and looking for people externally to validate what I was all about. So all of you have these little whispers over the decades that if we don't deal with it now, it will result in a brick. And my brick was the bankruptcy. So the bankruptcy was also, though, my rock bottom, and it was my pivot point that really motivated me to take the next 10 years to understand how to actually master money. And what a lot of us think, and what we're kind of conditioned to think of in society, is that it's all about money management. It's just how you manage it. That's it. But the irony in this, and the damage in this, the danger in thinking that it's all about money management, is that money management is probably the easiest part of the whole solution, the easiest part of the formula, and it probably accounts for 10%. The rest falls into money mindset, which is how our mind is wired. And then the most uncomfortable piece of this formula is what I call money motive. And this is the cellular biology piece. Now, I'm going to warn you, we might not have time to cover all of this today, but rest assured, I'm actually going to do 2 videos for women entrepreneurs for your exchange group that will speak about money mindset in detail, because that's probably going to be 20 minutes, and money motive in detail, another 20 minutes. So I'll send the link to Candyce, and then Candyce can send it to you, and you can watch it whenever you want. But today we're going to focus primarily on money management in business. That's where we're going to spend our time. So what I want you to just be aware of, because a lot of people feel alone in their financial struggles, is that before COVID, 71% of all the business failures that we were seeing in this country were attributed to poor financial management. And at the end of the day, the real cause of that is no net profit. No net profit. That's why businesses collapse. It's not top line sales, it's about not having the profit. So 89% of the businesses that I have worked with in the last 10 years, so if you're falling into this bucket again, I want you to realize that you're not on your own. 89% of the businesses that I work with come to me with great pride and great, and I don't want to dismiss the pride, but they're very proud of their net profit that is sitting at about 2 to 3%. Now, some business owners don't even know what their net profit is. Most people are looking 4 months after year end when they get their notice to reader from their accountants, and they're like, oh, I didn't make money, or oh, I did. That's a surprise, right? It's a surprise usually. And so what is so damaging about this is that 2 to 3, we're what they call in the black, right? Now we're in the black. Now we're breaking even finally. But what do you think the number one expense that most business owners forget to account for is? Throw it in the chat, put it wherever you can. Let me know what you think that is. I'm looking for my chat here. Candyce, any answers? What are we seeing? Paying themselves. Rosalie, ding, 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 ding. Corliss, yes, taxes. We're going to talk about that in a minute. Mandy, absolutely. You're absolutely right. So guess what? You add a fair market owner salary into the operating expenses, and we're in a deficit position again. So women especially, we tend to skew what I call money martyr. It's a money type, and we are the self-sacrificing perfectionists that put everything else before us. It's my experience that almost 90% of us are skewing money martyr in business, which means we're not paying ourselves, which means we're compromising our family at home, right? So we need to get our head around this. Now, a couple reasons why this happens is that A, we're not taught about money, and B, there's this huge stigma around profiting in business. Every single time. I remember at the beginning of COVID when all of the old age homes were talking about, or assisted care, were talking about the COVID cases they were getting, and everybody was so angry at them, going, oh, these profit hungry buggers and, you know, capitalists and opportunists. And it is that stigma that prevents us from profiting in business. So again, what I really want you to take away, if you're going to take away one thing from this presentation, please, please, please let it be that profit is where it is at. There is no, I don't want you to feel guilty about profiting. I don't want you to feel any shame about profiting, because profiting at the end of the day is what is going to ensure our survival in business. And this is why 2 weeks into COVID, 2 weeks into it, we saw the collapse of businesses like we did, because there was no net profit. Net profit is what allows you to survive the economic downturns. Does that make sense for everybody? Is everybody picking up what I'm saying here? Profit, 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 profit. So the importance with profit, obviously, now you can pay yourself, you can pay your dividends. When you're sitting with a net profit, think of it almost like your safety net that you have at home, your emergency fund. When you have retained earnings, that's what net profit is. You take your net profit and you move it to the side. Now you have a safety net. It's a confidence booster. You're able to recruit and retain really great people. You're able to expand your operations. You're able to acquire assets. Now, I just want to speak about this for a moment, because many of you might not be thinking about this right now. But one of the number one things that you look at when you're looking to invest in a company on a stock market is you look to see what capital they have on hand. Because the companies that do very well in times of economic turmoil, like now, like a global pandemic, are the ones that have the money to buy up all the struggling businesses. And this is how they turn into big businesses. They don't reinvent the wheel every time. They just go acquire company A, B, C, and now they're 3 times as big by offering the same product or service, but their market has just grown by 3 times. And they get these companies for pennies on a dollar. This is why we want profit. I want all of you thinking like business women now. You are no longer employees of your business. You are CEOs. And the other piece is that you are actually an investor. You are an investor in your business. And I'm going to speak to this, but it is incredible to me when you think about your net profit, and everyone gets so excited about the 2 to 3%. You could go down to a bank, you could put the money that you've put into your business into an index fund, and you could make 7 to 8% on your money for 10 minutes worth of work. So you as an investor now that is saying it's okay to make 2% on your money, that does not cut it. You really need to shift your mindset and think, I'm a CEO, I'm an investor, I'm going to make smart decisions that build the investment of my business. So your net profit is basically the return on your investment. If you start thinking like that, it's a complete game changer. Now, very quickly, again, I don't want you to get overwhelmed with all of the numbers. I just want you to kind of step away from this and realize that there's a process to this. But in finance, in our relationship with money, there's always 5 pillars, in life and in business. There's save, share, spend, invest, and earn. And the same is true in business. And so here, I want you to know that earnings is sales, spending is our cost of goods and our operating, so our direct costs and our indirect costs. Sharing is taxes and any sort of corporate giving or social impact that we're looking to make, right? For like, you think of Tom's, for example, for every pair of shoes you buy, we're planting a tree, right? That is a piece of our share strategy, our share bucket here. And investing, as we talked about, is your bottom line. It is your net profit, is the rate of return that you're getting. So what I want to point out here is that most of you are probably looking at a sheet very similar to this. This is your income statement, and you're looking at it 4 months after year end, and you're trying to make sense of what all of this is trying to tell you here. And, you know, obviously me personally, I go right down to the bottom and I'm like, okay, 2015, this business made 121 in profit. 2016, we're at a deficit, 151. So there's a couple of things with this that I personally don't like, but this happens with all of your accountants, is that we lump all of the revenues into sales, into one bucket called sales. You'll see with our expenses, and this is a short list. Sometimes we see a list of, 25 different expense categories, very hard to make sense of it. So one of the things that I want you to know is there's a tool called the Highways and Hazards. And I apologize, it's not posted, but I'm going to post it as soon as we finish this call. And I'm going to post it to the website called nailthenumbers.com. And you are going to go, I'm going to show you how to get it. And I can see maybe it's going into the chat. But it's a tool where you are going to input your numbers. That's all you have to do. You don't even need to make sense of your numbers. Just import the numbers. And then this tool converts everything into a percentage. And as soon as you start to convert into percentages, wow, everything starts to show up for you. So this is an example. This is the same example of the notice to reader that we were looking at. And this is when I'm coming in to actually kind of do this forensic assessment on why a company might be at 4 million in sales, but is at $151,000 deficit. What are they doing wrong? This is the first step I do. And so this is the actual first step I want you to do with your business. Take these numbers, convert them into percentages. Right away, I want you to look at your net profit. What story is it telling? In this case, you can see it's interesting. -1 up to 18. Wow, what were they doing this year that made them so profitable? Down to 14 negative net profit. And then we have 2.89, 1.14, 1.83, down 14 again. So this is going to show you where we've got some issues. We can see what years we had issues with our net profit. Then right away, I usually go up here to sales to make sure that there is sales. And you can see in this business, they started at 218 and they jumped over the years. They went up to 4 million. Can everybody see that? Or I hope you can. I'm going to move my gallery view. So they went up to 4 million. So again, proof of concept, which is where all of you are at. You've proven your concept. You know that there's an appetite for what you are selling. Then right away, I typically go to direct costs. And I'm going to share this with you again, but usually where businesses are losing money, if you don't have a net profit or if it's a weak net profit, typically where the loss is in a mix between your direct costs and your pricing strategy. That's usually where it is. It is usually not in operating expenses. There's one little caveat here that we'll talk about. Usually 99.9% of the time, we need to increase operating expenses because you're all operating on this bootstrap budget, trying to do everything yourself. And when you actually start to recognize what needs to be done to turn this into a business investment, your expenses are actually going to grow. So in this case, you'll see, well, first of all, no darn business can operate at 110% cost of goods. It's just like out of the gate, you're hooped. And so we just take a look at this and we start to, again, what's going to pop out is the highways and hazards. What is working and what isn't working. And the big piece here, again, as we mentioned, is that most businesses are lumping everything into sales. So what this did not tell them for the first couple of years is what product or service is actually selling. Right? And then what the other big mistake is usually under direct cost of goods, we lump that all into one bucket. And when we do that, we're not able to find out which product or service is most profitable. So you have to make sure you have a bucket of cost of goods attached to each revenue stream. That's the only way you're going to be able to answer that question. And then just really high level here, what was interesting for me when I look at this is that oftentimes when businesses at your stage get to experience some success, we start introducing new products and services without doing all the math. And this is exactly what happened in this case. They started to diversify outside of their framing and renovations, and they started to get into custom homes. And so one of the trends you want to look for is to see, you can see in this case that their renovations started to slow down, their custom homes picked up, and obviously their net profit started to dip. So that for me right away, very quickly, I'm starting to think, okay, I think there's a correlation between this growth in home sales, something to do with direct costs, and obviously we've got a challenge here with this net profit. Now, what I want to point out here is that this client came to me to ask me to grow revenue. They said, can we please grow this revenue? That's what we want to do. We think that's going to fix the problem. And at the end of the day, it did not fix the problem, or it would not fix the problem. It would have actually turned the net profit into negative 30%. So your answer is not always found in getting more money. So here's 8 steps. So once you get the highways and hazards done, here's the 8 things that you need to do to profit powerfully. The first thing you need to do is you need to figure out your personal budget, because come hell or high water, your business needs to pay you what you need to create financial security and stability at home. And most of you are just paying what the business can afford you. That's what the vast majority of you are doing. And this is where you're compromising yourself and your family. The second thing we do is what we call indirect expenses, right? AKA operating expenses. We're going to go through, we're going to put those into 4 different categories, and we're going to actually probably increase expenses, knowing now that we're an investor and we want to turn this into a business investment. The third thing we do is revenue streams. We separate those out, also known as profit centers. The fourth thing we do is we establish a price for each revenue stream. And most women in business are undercharging. They're undervaluing their product or service. Number 5 is direct expenses. So what are the costs that are specifically attached to profiting are specifically attached to selling that product or service? That's what a direct expense is, also known as a cost of goods. Then we have plan for profit, which you'll see is just super, super easy. We then do what's called a marketing map, which now defends the sales that we need to generate so that we can take care of the cost of goods. We can take care of the operating expenses, including a salary, which will then also influence our marketing budget. And then obviously milestones and measurements. So the work that I'm asking you to do in this process, and I want you to think of these as 8 little mini processes. Otherwise, this is going to overwhelm you. You're going to be like, what? There's too much work here. Your subconscious is going to say, reject, 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 right? Don't want to do it. So just 8 little mini projects. That's all you have to do. You just take one at a time. And when you do this work, you're going to end up with what is called a financially viable model. This is how not only does your business make money, but you also have a profit at the end, which investors get excited about, which creates security for you. And then we just kind of break that down. So if that's the goal, how long will it take us to get there? Maybe 3 years. And then we just break it down into like quarterly objectives. So we're going to start here, but we're going to end there. That's how this works. Very quickly, I am going to assume, based on your revenue, that I think the majority of you are familiar with the financial statement piece, right? We have a balance sheet, we have an income statement, we have a cash flow. The same thing applies in life, except the balance sheet is called a net worth statement. It's a list of all of your assets minus all of your liabilities. The income statement at home is called your T4. It's a high level summary. What did you make minus your expenses? What are you left with? Your net profit. And then we have the cash flow, which is a budget. And all the work that I am talking about today falls in our budget, both at home and in business. And the vast majority of business owners don't budget in business. Usually when I see this is when a business owner is looking to secure capital, and then they do the cash flow because it's mandated. So this is the work that we're going to do today. So again, high level. And again, I want you to know that there are all sorts of tools for this, tools and templates. So I don't want you to feel like you've got to do this all on your own. But the very first thing you need to do in business is you need to figure out how much you need to get paid, regardless of what a fair market salary is. So savings is short-term security. It's your emergency net. You might have gone through it through COVID. So you might need to restore that balance, right? So how much money every month do you need to be putting aside to get your security net, your short-term emergency fund reestablished? Spending, how much money on needs, wants, what I call the splurge account. So this isn't about living in scarcity. This is still about having experiences, but potentially most importantly, how do we get you out of debt in 36 months? So what is the number that you need to generate so you can make that happen? Invest, how much money do you need to be putting aside every single month so that you can make your darn nest egg number? And the younger you are, probably the less likely you are to think about this, but the younger you are, the more of an advantage you have because your money has more time to make money, compounded interest. So in the tools that I have, it'll actually show you how to calculate how much money you need. Because most of you don't even, I don't know how much I need in retirement. That's usually the number one answer I get. And we abdicate it to bookkeepers and we abdicate it to our financial advisors to let them tell us what we need. We should know it. We need to take ownership of that. And then share. So share is about our giving for societal impact. And unfortunately, most people who aren't sharing right now, it's usually because they say, I don't have the money. And then for the women in the group that have kids, guess what? Your kids hear that language. Your kids are hearing you say at the checkout counter and at the door when a solicitor comes by, pre-COVID, post-COVID, would you like to donate to? Usually it's like, we don't have cash, right? So your kids are watching all of that. They're observing, they're making an interpretation, and it is now forming their programming going forward the same way it formed ours. So all of this to say, you'll see here, and again, I want you to know that this playbook is available to you. Brittany has it, Candyce, I'll send it to you as well. So all of this is here for you. I've shared with you some common mistakes that entrepreneurs use or engage in, like cashing in their savings to start their business, cashing in their darn investments, which is long-term security to start their business, using credit cards for their business at 19.9%, right? And especially for, as Candyce mentioned, the taxes. So our business pays us what it can, and we take that $3,000 and we put it all towards the bills and the groceries. And then CRA comes at the end of the year and says, oh, well, you owe us tax on that $3,000. And now we're hooped again. And we go to our credit card to try to pay our taxes. So all of that to say that one of the biggest mistakes that we are all making is that we allow ourselves, we put ourselves in the position of taking what the business can afford to pay us. Now, most people, I'm going to tell you right now, most people refrain from doing this work because the real number of what the business probably needs to pay you is probably terrifying. Most people avoid it because they're afraid of what they're going to see. When I did this work, I went from $4,000 and I had to generate $35,000. And what I want to share with you right here is there's only two reasons why you're not making your magic number in life. One, you don't know what it is. Your subconscious wants to keep you from it. And two, 95% of the decisions that you are making every single day are coming from your subconscious. So you think you're making a decision, but it's actually the programming at the basis of the subconscious, and the subconscious is not motivated by the magic number. So even when you do this math, you're going to end up with a number in life and in business, and you're going to get really excited at the beginning. And then your subconscious, because here's the thing, your subconscious wants to stay in a state that it is familiar with. So whatever your financial situation feels like, when you think about debt, is it burden? Is it overwhelm? If you're hoarding money and not investing it because it's about being fearful, I don't want to lose it. All of the emotions that are attached to your relationship with money, it comes from a program, and your subconscious is calling the shots. And it is on autopilot and you're not even aware of it. You're not even aware of it. This is what is so important for all of you to understand, because that is the work that needs to get done. Okay, so if we go here to this step on direct expenses, there's just, or sorry, indirect costs, there's a couple of things I just want to bring to your attention. Owner's salary, we need to account for that. So I want you to go to payscale.ca. I want you to see what a fair market salary is for your job as a general manager. It'll ask you, you know, what city are you in, how many employees, what size, and it's going to give you a scale. From A to B, you know, here's kind of, you know, what somebody would be getting paid in that role if you had to pay them. Then in your position too, a lot of you, as you scale, one of the biggest things that you're going to scale with is your employees. So just a couple of notes here with employees. I want you, when you negotiate a wage, I want you to make sure that you're also adding source deductions of 16%. So if you're saying that you're paying someone $100,000 a year, it's actually 116. This is where you're going to get hooped. Whatever you don't budget for in your indirect costs, it comes off your profit. So budget for it here. This is your wish list. This is like, dear Santa, here's what this business needs. And again, most of you are not looking at all of the expenses. So this is where you put it in. The other piece that I just want to mention is that in here, in your business, you can actually budget for a pension plan. You can budget for a pension plan for you and or your employees. But the nice thing about this is that when you budget for it here, it becomes an operating expense, which means that money isn't taxed, like it might be if you took it out of your business and then look to put it into a pension plan or an investment at home. I don't want to get into that too much, but it's usually something that business owners aren't thinking about here. So one of the other pieces that's really important, I'm going to just flip over here to owner's dividend. You can see this. So let's say in my case, I had to go from 4,000 to 35,000. A fair owner's salary for me would not be 400,000. Any investor would look at that and go, no, we're not paying 400,000 a year. So what I can do is I can put fair market salary under team and personnel, and then I can show the dividend or the extra money that the business needs to pay me in the other category. Now, why this is so important to break it down into these 4 categories, these 4 buckets, instead of a list of 75 expenses, is that when you tally up all of these numbers under team and personnel, you can take your total, you can divide it by your revenue, and you can look to see if your team is actually productive or not. And there's benchmarks for that. Right? So if you're not making money somewhere, it's very easy to go team and personnel, total cost divided by revenue. Are you within industry average? Yes or no? No, there's a problem there. Sales and marketing is huge, because if you were to add up all of your sales and marketing costs, and let's say it comes out to 7% of your total revenue, what do you expect to see the next year or the next period over in terms of growth? Most people say 7%. We don't want to see 7%. We want to see a lift on our money. Otherwise, your marketing efforts are just breaking even. So we want to start seeing a lift there. Now, one of the things that I am going to recommend is with your marketing, I want you to budget for, now it depends on your revenue, but I would say budget for at least 3%, if not up to 5%, on a marketing mix. And it's just a placeholder. It's saying, here's a budget that I have for marketing, and I'm putting this in here for my planning processes only. And then I'm going to show you how we go back and fix that. But now you know that you've got a placeholder for marketing and that you've got a budget set aside, so you don't need to come back and redo all of this work. So this question here on why, you know, ask me about the 4 categories. This is why the 4 categories, so that you can measure exactly what the return on each one of these different investments is going to be. All right, this next step, step 3, is super easy. I just need you to break out your revenue streams. So instead of putting everything into sales, you break down, here are my top, and I don't want you to, definitely don't go over 10. I would say 5 is ideal. 3 to 5 revenue streams, your top 3 profit centers. How does your business make money? That's step 3, super easy. Now, I want to take some time to explain this piece, because as we mentioned, this is where a lot of business owners aren't cutting it. Women business owners aren't charging the right price. So here's what you need to do. For each product and service. You are going to select your product. You have to break this out. You're going to select which one you're going to evaluate to start with. The next thing you do is you research the competitive offering out there. So who are your competitors? What are they offering? What are the differences between that offering? And I have a worksheet for this for you. And then what is the price that they're charging? Step 3, you determine the consumer's top decision-making criteria. So what is going through the consumer's head, not your head, with respect to when they're evaluating this decision? Do I want to buy this from this business or not? And then you're going to score your product or service. So what we have here is an example of, this would be service, right? So soft skills, these are the people skills, you know, the project management skills. Hard skills would be technical, industry experience, the promise of the brand. So are you a high value brand, or are you a dollar store? Are you a Holt Renfrew? Or are you a dollar store? Your unique offering, is there a lot of competition in your space or just a little? And the pain point, are you solving a nick, a scratch, or are you actually, you know, life-saving operation, right? Life-saving surgery in there. So you have to objectively go in and start to weigh yourself. And so in this situation, this business owner is saying, okay, people skills, a 3 out of 5. Hard skills, technical skills, 4 out of 5. Industry experience, they gave themselves a 4. Brand promise, they said, we're the best of the best, a 5. Unique offering, not a lot of competition in their space, so they gave themselves a 4. And then pain point, 3. So they weren't life-saving, and they were they were right in the middle there. So all you have to do, and I just want to make a note of this, your criteria might not be the same as this. Every time I do this with a customer one-on-one, the criteria always varies. But you pick the criteria, you can use this as a template if you want, but then you score yourself, and now you add up your score. So in this case, it comes out to 23, and then we divide it by the amount of criteria that we chose. In this case, it was 6, which means we have a score of 4. So the next thing you need to do is, on this chart, you can see that we go from 25,000 to 125. So again, this is hypothetical, but out of their competitors, the lowest competitor is charging 25, and the highest competitor is charging 125. And so if you're going to fall on a scale of 4, 1, 2, 3, 4, we know that your product or service needs to be priced at approximately $100. Now, most of you are probably charging anywhere from 50 to 75. That's been my experience. And you're going to see this new price, and you're probably going to want to vomit, and you're going to go, oh, how the heck am I ever going to charge that? What I love about this model is that, A, you've actually been able to defend the price because you've done this work. And when you actually start thinking about why you gave yourself the score you did, I want you to write it down, because those become your key messages in marketing. That's it. You're already seeing it from the customer perspective. So this, I mean, this counteracts so many different challenges that business owners have with setting the price, and then how do you let people know, and how do you get around the awkwardness of defending it? So that is the pricing model. Step 5, this is direct costs, also known as costs of good. Now, I just want to be mindful of our time. And Candice, I have till when again? Is it 10:15? 10:20? A little bit of a buffer? Sorry, Candice, you're on mute. You can hold up.
10:30 is our
okay.
break time, so 10:15, okay. And then we could do questions till 10:30.
Perfect. Yeah, I'd love to take questions. Have there been any questions so far, Candice?
Not yet. Just
Not
some
yet.
comments
Okay.
of all the gold you're offering.
Okay. So direct costs, again, please, this is where most companies are losing money, is the pricing and the direct costs. So this can be a challenge to actually go through this exercise, but I want you to do this, because this is probably where you're hemorrhaging money too. So direct costs, the first thing we do in direct costs, again, for each product and each service, we do this exercise. we take a look at all of the material. So in this case, we're selling a widget. Material is usually very easy for people to calculate. It's like, oh, we've got that. We think of a glass of lemonade. We got the lemonade. We got the lemon garnish. We got the ice. We got the napkin. We got the glass. We got the napkin, right? Usually that's where people stop. I want you to consider inputs for selling that, including merchant fees. And 99.9% of the clients I work with put merchant fees and operating expenses because that's how their bookkeeper and accountant have set it up. But merchant fees, 2 to 3%, get attached to the sales volume you have. So there's a big difference in 2 to 3% from 25,000 to 250,000. If you don't budget for it in cost of goods, it comes right off of your profit margin. So that's right there, you're making an extra 3% on your net profit. Just that one little thing alone. So then budget for shipping, duties, exchange rates, any subcontractors you have. And if you do have some contractors, make sure that you get a contract that lists out what their value is, what they're providing, and for how long that price is in effect, what the terms are, because they can change that on you very quickly. Make sure it accounts for any per diems, for travel, for any of those extra expenses so you know exactly what you're dealing with. Otherwise, it just comes right off your net profit. And any sort of commissions you have or affiliate fees, it goes in here because, again, it scales with your revenue. It is not a fixed expense. So that is step one. So you add your materials plus your inputs, and in this case, you can see it's $50. You take $50 and you divide it by the selling price that you're asking for. Now you end up with 50% cost of goods. Done. You do this for each product and service. Now you know what your direct costs are. But now I want you to do the second level, because this, again, oftentimes we're losing money in shipping and the merchant fees and the commissions, but a lot of us are losing money on the labor piece. So what I want you to do with the labor is and this is very important as you grow your team as well. This serves a dual purpose. I want you to list every single task associated with selling that product or service. Now, this is mostly going to apply to services, but I want you to list out every task, how much time it takes, and the rate that you would have to pay someone to get that done. Now you are going to end up with labor costs per product or service. And the reason why I want you to do this is because when you add that labor, do you have the right pricing strategy? Because if you add all of this up and you're sitting at 95% cost of goods, you are not going to survive in business with your team. This is not going to work. We have to find a different way around this. So the only reason why we're doing this is to make sure it's viable. Now, what is so powerful about this is that when you're listing these tasks and the time it takes to complete it, now you go to your team member and you say, hey, Jimmy, this is what I'm asking you to do, and this is how much time we've budgeted for it to take. Now you hold them accountable. Brenda, you have a question.
I do. I have a quick question.
Brilliant.
I know we went through the whole piece about the indirect costs, but is there a way, and we may be getting to it, how to tie those indirect costs on a per item basis?
Indirect cost per item.
What I'm getting at is all the overhead. Okay.
Not today, but you can reach out to me. Every case is very different because I know sometimes there's businesses that have high energy costs associated with their product or service. And so we would calculate that, but we'd be here for a week if I went through every industry. But please reach out to me personally, Brenda. I'll spend time with you so that we can understand exactly what your business, what your industry is, and how to calculate some of those indirect costs into that.
Thank you.
Okay, thank you for the question. Absolutely. So the second piece with this, as I mentioned, with the labor is now we can hold our team accountable to a very specific process. And it might change, but it's a starting point. Now, the other really important piece with this is that, especially for service-based businesses, oftentimes we look at calculating the costs based on our delivery, right? Based on actually providing that product or service. But I want you to remember there's 4 stages of engagement with the customer. There's what I call the discovery. You haven't even won the business yet. This is you sitting down with the customer, having the phone call with them. What are your needs? How can we serve you? It's what our team looks like. Sometimes it's the road and pony show. Sometimes you have to build the proposal, right? All of that gets attached to selling this customer the product or service. So we have to account for that time. Usually that's time in there, but sometimes there's printing of the proposal, there's shipping of the proposal. Then we get into what I call the develop stage, which is now the client has said, yes, they want to go for it, but you might need to tweak some things with that proposal to make sure, maybe it's the price, whatever it is. And then this is usually where we need to start engaging all of the trades or the subcontractors. We need to start ordering the supplies. All of that time goes into it, right? And most people are forgetting that cost. And it's amazing when you do this math, at the end of it, you're usually gobsmacked. You're like, what the heck? This is actually costing me $110 and I'm selling it for $100. No wonder I'm hurting. And then we get into delivery, and that's usually where people calculate the numbers. And then the fourth stage where people forget is the defending. So how do you create a raving fan out of your customer? Are you sending them a thank you gift? Are you organizing an open house? Are you doing a media release? All of these things should be calculated in your cost of goods, because this is where we hemorrhage the money. That's a terrible word to use with a group of women. Sorry, that wasn't good, but this is where we're usually losing all of our dough. So here we go. This is going to be super fast because, yeah, this is just, sometimes it can take an hour to explain this in detail. I lose people here, but I want you to know, again, there's a process. And in this playbook, I've written it down step by step by step. But instead of just building a budget that's based on top line sales, or worse yet, we're just going to get 2% of the market, right? That's a big thing with our sales and marketing strategy. I actually want you to go through this process. And again, we have templates for this. But the first thing you do is you've already done this. You take all of your indirect costs and you know exactly how much those have come out to. Those 4 categories, you add them up together. In this case, it's $100,000. Step 2 is we actually understand the percentage value of our cost of goods. We've done that exercise for each product and service, right? So we add them up together, we get an average, and in this case, it's 50%. If only numbers were this clear cut when you actually do it, but we're trying to make it simple. Step 3 is I want you to plan for your bottom line profit. Before you even touch sales, you have to plan for your bottom line profit. So in this case, I've suggested 10. And when I'm working with a client one-on-one, I always suggest 10%. Because I know if you can go take your money down to a bank and make 8% in index fund, and if you invested in tech stocks this week, you'd be making 16%. That why would we be okay with 2? Why? It boggles my mind, especially because we're putting in 24/7 of effort, right? So 10% over here. The next step is step 4. So this is really easy math. Your 50% of direct costs as a percentage, and I can't find my arrow. Where's my arrow? Where's my little mouse? Your 50% plus your 10% equals 60%. 60% minus 100. By the way, spoiler alert, total sales is always going to be 100%. You don't have to do any math there. It's always 100. 100% of sales is 100% of sales. That's it. So 60% minus 100 means that, no way around it, your indirect costs need to be 40% of sales. They need to be. That's just, it's the math. That's what I love about math, black and white. There's no way around it. That's exactly how that's going to work. So then all you do to find out how much money you actually really need to be generating is we take your total indirect, we take your, indirect cost of $100,000. We divide it by 40%, and please make sure it's 40%. 40%. And then that will show us, when we do that math, bing, oh my goodness, we need sales of 250,000. That it's that simple. All the hard work is in figuring out your indirect costs, your pricing, and your direct costs. That's the work. Everything else just magically aligns. That's the work. So now we know that your business needs to generate $250,000 with your direct costs at 50%. So if we take that off, that's now 125 is set aside for direct costs. Your indirect costs, because you've already done that math, is 100,000. And now you end up with $25,000 of net profit. So again, what's really important here is that all your indirect costs that you've budgeted for those, because if you don't, it's coming off your net profit and you have to redo the math. That's it. So that 250,000, that is now our magic number in business. And remember, this indirect cost, this included a salary for you in operating that you take out every single month, regardless of whether or not you sell anything. Bam, done. So that is what ensures your financial security in business, not only for you, because if you're compromised at home financially, your business is compromised. You don't have a chance. So now we're making sure you're taken care of, your employees are taken care of, your clients who have invested in you with their dollars are taken care of, and any sort of investors, whether it's women entrepreneurs, whether it's WESC, whether it's a bank, whether it's friends and family, you're taking care of everyone. There is no greed in profit, and then that profit goes into your retained earnings. So please, 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 when you end up with that $25,000 in your bank account, what I'm going to ask you to do is we're going to start to see that every single month. I want you to set up a bank account where you put that aside every month. You put it, because if it's out of sight, it's out of mind. What most people do is they see the money sitting there, they get really excited, and they're like, woo, let's go buy a new building. Woo, let's go buy a new car. Woo, let's go hire someone. This is not how it works. This is not what we do. We make sure that if we have to hire someone, we budget for that, and we see how much money we need to have set aside so that we can pay for them without depleting that entire account. And if you're going to deplete it, this is when we go and we look for a loan from WESC to say, you know what, I need X amount of cash to be able to afford this team, but this team is going to generate this revenue and allow me to repay your loan. It's that simple. That's exactly how that works. Okay, moving right along. So I just want to show you, remember this at the beginning of our presentation, this like schmozzle of percentages. We went through this exact same process. So this was a construction company, as you probably were able to tell with renovations. We separated out their revenue stream. So we didn't just do renovations in homes, we did renovations medium, large, and extra large. You will recall from the numbers that we looked at, they were generating 4.1 million. Their direct costs were 110%. Their indirect costs were 3.79, and they had a negative 14% net profit. We went through this exact process. This happens again, every business, every stage of business, regardless of industry, geography, it's the exact same process. We split out their revenue streams. So step number one, we actually went through indirect costs. We did the buckets. We paid them for the first time ever a salary. So indirect costs went from 3.79 to 10.78. Huge. We increased them, which is what's probably going to happen for you. But then we separated out the revenue streams. We did the cost of sales for each revenue stream. Before, they never did that. It was just one big bucket over here and one big bucket over there, and that's where all their issues were. So we figured out the cost of goods for each one. We got the average, right? And then when we did all of this math, I wanted to leave them, in this case, it was a 9.3% net profit. Their revenues went down. We went from 4.1, the plan now was actually 3.8. But for the first time in 5 years, they had paid themselves, and they ended up with a very healthy profit of $353,000 in the plan. Now, the irony in this is that it didn't go according to plan, and it never does. It was better. They ended up with almost $500,000 in net profit at the end of the year. They ended up forming an advisory board, and I'm so glad they did, because they asked me to sit on it. And as they were sitting with that 500,000, guess what their first question was? Should we go buy a building I went, you guys, you're not learning. No, you put that aside. They are doing phenomenally right now. They have actually expanded their team, and their net profit last year was over $1 million. Now, what is so amazing about this is that when you figure out what your sales need to be, and this is kind of the last thing I'm going to leave you with, and obviously we did not get to mindset or motive, but I will do a video for it, is that when you know what your sales need to be, I want you to apply this rule of 10, unless you can defend otherwise, which means that in this case, if we're looking to sell 2,500 widgets, right? We know that each widget is $100, which will allow us to generate the revenue that we need. So if we're looking to sell 2,500 widgets, it actually means that to have enough people even engaged with us, which they're usually sitting on the fence, we haven't talked price yet, but they're really loving you, they love what you do, we actually need to have 25,000. Now, this is a consumer-based model. This is not business to business, obviously, otherwise you're gonna panic. But I want you to realize that at this stage in engaged, we need 2,500 people, 25,000 people, sorry. Now, to get 25,000 people engaged, we actually need, if we take the rule of 10, we need another 10%. So we need 250,000 people that are interested. And again, with the rule of 10, if we're going to have 250,000 interested people, now we actually need to get 2,000 or 2,500,000 aware. And it might sound terrifying at the beginning, but when you break that down per month, it's not bad. I wrote the number down somewhere, 208,000 people a month. Through social media, you do that like that. Right? So typically the tools in each one of these stages, they're under awareness. Social media is a huge piece. If you're business to business, you go out and you directly approach these clients, right? Most people are afraid of doing that. So you're thinking of everything under the sun to avoid that direct call or that direct email. Don't. You're just adding more time and more expense to it. Interested is usually either the discovery interview or a website. This is where people usually go to validate what it is that you do. Engaged is now we're on one-on-one, and usually in engaged, this is where we start talking price. This is where we start talking price. And please, I didn't mention this, please, for the love of Pete, do not discount. Do not discount, because discounting just discounts your value. And now you're going to get everyone thinking that they can do this all the time. And you're going to see here, I'm about to offer you a discount, but it's because that discount price has been afforded by West. They're the ones that have made up that deal. So unless you know you're getting that money from another source, right, you don't discount. You do value add. You do value add. So instead of, as an example, if I've got a service that I'm selling at $2,000 and I'm thinking, oh, you know what? I'm going to take off 25% and I'm giving that to you now for 1,500. Why not, if my service is financial planning, why wouldn't I go and get a bookkeeper to add value? I'm ready to lose $500. So I just take 500 off. I get the bookkeeper to actually chart all the numbers at the end for the client. It's a value add. So same price, but I'm giving you $500 in value. And now the value of everything just goes up. So sorry, that was a side rail because we didn't talk about discounting, but please, for the love of Pete, don't. So under each one of these, you're going to see that there's going to be specific materials that are required, right? And not only developed, but created, right? So maybe you need a Facebook ad. Now you've got to pay for someone to actually do the ad. You've got to post the ad, and then you've got to obviously pay for the ad. So in each one of these categories, there's materials and tools that will need to be developed and then implemented, and that comes at a cost. And do you remember at the very beginning of our session, I said that marketing mix, just put a budget aside. That's where you now take this cost and you go back into cash flow and you change those numbers in your cash flow statement, and you haven't compromised your profit. In most cases, because the amount that I'm asking you to hold is more than you need, now your profit goes up. Or you don't need to make as many sales, but I prefer that your profit just goes up because now you set that aside. So again, I know I've given you tons of information to digest here. I don't want you feeling you have to remember every single one of these steps. There's a process for this. And what I am willing to do is I'm going to share all the templates with you. no cost. If you want the templates, it's there. If you need to just touch base with me for 15 minutes here and there to say, how do I do it? I'm there for you. I want you to succeed through this. If you need extra support, there is a program, and it's called Profit Powerfully. And it's a mastermind group that we limit to 10 every time. And the next one is launching October 5th. And in that, it actually includes the money mindset and the money motive piece. Because again, tools and templates out the wazoo, you need to use them. And a lot of people are going to hesitate actually doing this. You might be excited now. And as we start to move through our life, we're going to find every excuse not to do the work, right? Every excuse. And by the way, excuses are just a little mechanism our subconscious uses to appease our prefrontal cortex into not doing the work. That's all it is. So next time you hear yourself saying an excuse, just go, subconscious, no, we need to do it. And so it's interesting because everyone thinks they have to do all the hard work. They have to work the 24/7. They need to dig in. They need to, I promise you, if you just do the uncomfortable work, the work that you've been putting off. So forget the Pantone swatches and how pretty your logo is and what color you're using for what. If you do the uncomfortable work, the getting your taxes organized, the doing the pricing, the having the difficult conversations, your life and your business transform overnight. And the uncomfortable work means that you're changing your programming of your subconscious. That's why it's uncomfortable. That's the only reason why. It's because your subconscious wants to stay in a state it's familiar with. So when you start doing the uncomfortable work, it resists it, but that means that you're changing. You're changing the pattern and the process, and it's brilliant. Okay, you've got this. That is what this slide is all about, and what I wanted you to take away from this. Pay yourself first. Don't compromise yourself, because otherwise everyone else is compromised. Pay yourself fairly. Price based on value. Plan for profit. Start with the end in mind. And this is really just a process. Again, it's the same process over and over and over again, and it works every single time. And don't overwhelm yourself with, oh my God, there's all this stuff to do. One small step at a time. That's the magic in life. One small step forward. The first step I'd like you to take is the highways and hazards. Highways and hazards. So it is 10:23 now. I will get that uploaded for you by 11 o'clock. Go to nailthenumbers.com to go get it. You're going to go to the homepage. You're going to see Founders Toolkit. And when you click on that, it's going to ask you for your email, but then you'll be in a vault that is, I'm not going to say it's a little overwhelming, but every single playbook that every Nail the Number Pro has ever presented in there. There's probably a list of 50 tools and calculators. Everything is there for you. It's all there. So the idea is that you succeed. If you need one-on-one help, please reach out. And if you want to take that program, because of the generosity of WESC, that program is available to you come October 5th, and it's limited to 10 people. And it's 8 weeks of everything that we just went through, but step by step by step by step. All right, my lovely ladies, let's take your questions.
There's just two in the queue here right now, Taunya. One was from Corliss. You talked earlier about the 4 stages of engagement. What was the third one?
Okay, so the 4 stages of engagement: discovery, develop, deliver. Sorry, I went through that quickly, Corliss, because that's usually the one everybody does the math on. And then the last one is defend. So usually what people are forgetting is the discovery piece, the develop piece, and then the defend piece. I see another question here from Mandy. Excuses are what our subconscious created to appease our prefrontal cortex. You are absolutely right. Nope, that's exactly it. This is what I love about the mindset piece, because when you can become aware, when you're actually just aware of what you're doing or what you're not doing, this is what actually starts to remedy the situation. When you're aware of yourself telling an excuse, awareness is where it all starts. It all starts. And the motive piece that we didn't talk about is that a lot of people, I want to share this with you because for 10 years, my whole life really, but for 10 years, I got so stuck on, I need to fix things. I need to fix things. Something's broken. I need to fix it. I need to figure out my pattern. I need to fix my pattern. I need to, sit down with my mom on a therapist couch. And you don't need to fix anything. You are not broken. You're not broken. What you need to do is you need to choose a different emotional state. That's it. And so that's the whole motive piece, and I'll do a video on it. But I just want you to know, please stop trying to fix things, because that is not what I want you to do. You don't have to fix anything. Awareness is what I want you to do under mindset. Please ask away. Yes, thanks, Candyce.
Okay, Taunya, my question is about the paying yourself first. So there's probably a lot of mindset that goes along with this, and there's probably a good explanation as to why women specifically feel like they can't pay themselves first. But you're recommending, if I'm getting this right, that we pay ourselves first no matter what, the fair market value. What if there isn't enough revenue coming in? So if you have subcontracted services, you have all these people that you're responsible to pay, you need to pay your operating expenses. I think a lot of us would probably, the reason we would pay ourselves last is because there isn't enough money coming in. So can you speak to that and help us kind of restructure that so that pay yourself first is, I guess, realistic?
Absolutely. So great question. And here's what I'm going to tell you. So first of all, you need to be aware that you are choosing to put yourself last. First of all, it's like, oh, what am I doing? Why am I doing that? Why does that keep coming up over and over again? So in the event where I have seen this beautiful transformation for women is that at the very beginning, if there isn't enough money that is coming in, here's what I want you to do. I still want you to pay yourself first. I want you to show that the cash is being transferred out of the business into your personal account. Because even just the physical action of that happening, you've still put yourself first. Now, if the cash needs to go back in, here's the brilliance. And I know accountants at the end of the year, they make all this magic happen, but I want you to be aware of it. If you need to now pay someone, now you take that money back and you show a transfer back into the business. Guess what? You are now lending the business that money. That business owes you that money back at some point. That's a shareholder loan. You're giving the business back the money. You're thinking like an investor, and now it's on the books that the business owes you that money back.
So it's like a shareholder loan. So it goes comes out as a draw and it goes back in as a shareholder loan.
It goes back in as a shareholder loan. Okay. And what most people, I know, frickin' brilliant, right? It's just a mindset shift. It's because we usually wait at the end of the year and the accountant is doing all of that. And they're like, oh, here's what I did. And I just did this and this and this. And now the business owes you this. But you start thinking differently. You start thinking, I lent the business this money. That is money that is owed to me. And it's those small little steps. It's because you start changing your programming. Here's the thing about motive. When you start changing and you do that uncomfortable work, you're showing your subconscious what it feels like to be an investor. And your subconscious starts to go, okay, I get it. I get what this feels like. I get what it feels like to feel powerful. I'm starting to get it. Your subconscious starts to make decisions for you that are in your interest. We don't get away from the 95% of our decisions being made by our subconscious. We can't change that. That's just how our mind works. What we have to do is we have to train our subconscious to know what that feeling is like, and then it starts to make those decisions. So that's what I would recommend for you, Corliss.
I love that a lot. And I just wanted to ask, because what I did
pay yourself, show it going back into the business as a shareholder loan.
Yeah, what I decided to do was every month I decided to have a meeting with my bookkeeper. So after she's got the month done, so that I could have it like a synopsis. So instead of it, at the end of the year, me seeing where it's going, we're like doing a meeting so that I can actually see exactly where the money's going, where the revenue's coming in, really thinking like a business owner, like almost looking at the finances every single month.
Absolutely. Good for you. And I think, what's really important with that, I love that you're looking at it every month. That's awesome. What I'm going to recommend when we're starting this process, look at it every week. Because when you're looking at it week to week, if you have an issue with your finances in the middle of the month, if there's an issue with your cost of goods and you're supposed to be at 74, but you're actually coming in at 78, you can fix it in the month.
Yeah.
You send someone home for 3 hours and you've already made back that 4%, right? But when we look at it at the end of the month, we can't fix it. It's just like when we look at it at the end of the year, it's done, it's gone. Right?
Okay, this is so funny because I felt like I was doing so good going from once a year to once a month, Taunya. Come on.
Oh, but Corliss, you are. And this is what happens. We start where we can. We do the best we can with the tools we have. And then we just get more and more and more in depth. This is the journey of life. We're never going to have it figured out. We're never going to arrive. The ducks aren't ever going to line up. We just get better and better. And oh, that's a terrible word. I don't want to say that because we already are amazing. We become our truest self by just shedding layers and arriving at new spaces every time. And usually it's because we're becoming more vulnerable through this process without all the armor. But Corliss, please, you are doing amazing. Don't discount what you've done. Yeah, okay, good.
Thank you.
We do have a couple in the queue and they're pretty aligned here from Dawn and Fly Fit, which is, I gotta remember all your names here now. So when you're paying yourself, do you recommend paying yourself as an employee or just through dividends? And then to back up on that, for a tax perspective, should it be salary dividends, contractor, kind of a similar layout there with shareholder loans?
Yeah, okay, so everybody's case is going to be a little bit different. Obviously, I mean, if there are sole proprietors, right? Sole proprietors, all the income that you're making in business is all, income minus expenses. You're going to be taxed on that as a sole proprietor at whatever your rate is. So anywhere from 24 to 33% on that net profit, right? Including all your home expenses. As an incorporated company, it's 12, right, on that net profit. So there's definitely advantages there. But the other thing that I want you all to be aware of is this. It is that most entrepreneurs, sorry, I'm going to close down the chat because I've got this big white block in front of me and I'm getting distracted. What is happening is that most of us at home have not fully utilized our RRSP contributions, our TSFA contributions. We haven't set aside the RESP contributions, right? We have so much room to play with that's usually what I'm seeing with most people, that when we start taking that salary in, and this is the brilliance of financial advisors and your accountants, they should be working with you to say, okay, if you're bringing this income here and we've got 50,000 of space to top up on your RRSPs, that is going to mitigate your taxes. One of the most valuable roles of our accountant is to mitigate taxes at home and at business. And if you can, I love it when we have an accountant that does both our personal tax and our business taxes, because they're looking out for us on both fronts. And they should be telling us at the end of the year, at RSP time, I want you to top up over here because now we mitigate your taxes. A lot of entrepreneurs that I work with, they pay very little in taxes because we move over all of that money into the contributions and build up their nest egg and build up the RESPs. Right? There's lots of space there. Lots of space. So I hope that, again, please reach out to me directly. I'm happy to take that question on. There's a lot on that. There's a lot of meat to chew off that bone in a minute, but happy to walk you through all of your options with that. The big piece I want you to take away from that too is that every single person you're going to speak to is going to have an opinion about what you should do. I always have a rule of 3. Whether it's an accountant, a lawyer, a financial advisor, a marketing consultant, you understand what questions you need to ask them. You ask those 3 people the same questions, and then you make an informed decision on who you're going with and why. It's the same thing with numbers. Why are you pricing it at that? For these reasons. 1, 2, 3. Why is your net profit this? For these reasons. 1, 2, 3. Right? I asked a client the other day, why is your cost of goods sitting at 74 when we had budgeted for it to be at 83? And they were able to say, oh, it's because we offered the discount. We got this price from the, it was brilliant. I loved it. They're changing and starting to think. Always be able to defend your answer. And if you can't, you dig in and you find the answer to it. You ladies are very generous with your time. Thank you. It's 10:35. I've taken you away from your break. I don't want to do that. Breaks are important. You deserve them. So please reach out to me. Reach out to me directly. I'm going to get Brittany and Candice the playbook. All of my contact information is in there. My Nail the Numbers is where I'm going to put the tools, and my email is taunya@epiphany.ca. But please, 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 I'm here to help, and I want to make sure that you've got a really solid financial footing, especially now through COVID. Anyone can still do this. I've got clients that are posting banner months. I've got clients that are, with respect to profit and sales, it is all doable. We just need to shift the mindset.
Mm-hmm. Absolutely.
Okay. All right, everybody. Thank you for your time. I'm going to step out of this picture. You're all lovely, and I hope to hear from you all. Okay. Bye for now. Thank you, Candice, for everything.
Thank you.
Thank you.